Hey folks, my name's Scott Miller. This is IT Rockstars. Welcome along to our YouTube channel. We help MSPs, IT companies, technology companies, whatever you want to call yourself. Our whole mission here at IT Rockstars is to help you grow your IT business by 20%. So the way that we do that is through our marketing at itrockstars.net. Go and check that out if you haven't already. You can sign up for the 1-month free trial. And that 20% is on addition to whatever you're doing already at the moment. So we're going to add an extra 20% to your business. So on today's show, we have someone that's been on the show before. It's been on the YouTube channel before, actually. Now, this gentleman has run and sold an MSP business. He has been in the consultancy / recruitment space, coaching maybe. That's maybe a better term for it. I'm not sure. We can get into that a little bit later. He's been in that space for a while since selling his MSP and working with other MSPs with their business and helping them improve their MSPs. So last time we had him on, we were speaking about recruitment for IT technology companies, and we've got a whole recruitment masterclass that is now on our YouTube channel. You can go back in time and check that out. I'll leave a link in the show notes. But on today's show, I'm going to welcome Daneil Welling of Welling MSP. He's here today to speak about M&A valuations, and we've got a whole nice little slide deck here that Daniel's put together with his face on the actual slides, which is awesome. But I've got some questions as well, so I'm just going to be jumping in as Daniel kind of gives us a little bit more information about mergers and acquisitions in the MSP space. So welcome along to the show, Daniel. How are you doing?
Very good. Yeah, thanks for having me. Great to be here. And as you say, we've would you say worked together, or
I think we've referred business potentially. You've certainly referred business to me, Daniel. I know that. So
and
I think that's how it's worked so far.
Absolutely. So yeah, and been great working together so far, and yeah, happy to contribute where I can, and I guess just in terms of the background to this, as you say, there's a presentation I've put together here which will be aired probably via a number of channels over the coming months, but today we'll probably skip over some of the content that perhaps isn't directly relevant, and ultimately, hopefully, linger on some of the topics that you think are of particular interest to your listeners, and of course to yourself as well. Yeah. And yeah, really, this is expected to be the first of a number of presentations that I put together around mergers and acquisitions generally, but certainly the work I've been doing thus far with my clients on the M&A side. Valuation has always been one of the very early topics that had interest or has interest. So I thought I'd start with valuations and go from there.
Now, before we get stuck into this, Daniel, a question for you. Our audience here at IT Rockstars, we've got members from all over the globe, Australia, New Zealand, Canada, US. Majority of our members are actually based in the US. We're obviously based UK. So the information you're going to kind of detail here, can it be applied to, first world countries globally?
Good question. I would. I'd probably say all of this is based on my experience of the UK market,
okay.
And I've got an increase in international exposure, and I think there are probably some differences market to market. However, ultimately it all comes down to the same numbers, and therefore I would expect a good deal of this to apply internationally rather than just within the UK market. But awesome. I stand to be corrected, and every day is a school day.
Cool. So as we're recording this, January 2020, we might be going back in time when we look at this in the future, but at the moment, I am kind of aware, just a sense that there are a lot of acquisitions happening at the moment. The market's maturing. Would that be a correct assumption?
Yeah, absolutely. And it's not a new thing. There's been M&A activity for many years, and in fact, this marks 5 years since I sold my business, and certainly I wasn't one of the first ones. I think there's always been a mature M&A activity level within larger businesses. I think probably where it's starting to become more apparent is in the mid to small end of the market. And I think that's where potentially you see the increased activity or awareness of the activity, and the reason for that is there's only so many larger businesses that are available, and therefore once business A has acquired business B, they have to then start either looking at smaller or larger businesses as their next target. So yeah, as the market matures and the activity level increases in that traditional space, it's overflowing now into the smaller, the level below, and then the level below that, and so on.
And that's certainly what I've heard is, I mean, obviously at the moment, as again, 2020 time recording, credit's readily available. And it seems to be, or it seems to me anyway, that there's a number of technology businesses, the way they're going around, because, the client base for an MSP are fairly sticky. The best way to actually acquire those clients is actually through buying another business. And that's seen as almost like an easier option or an easier route. That's certainly what I've heard anyway, Daniel. So let's get stuck in here to these slides. We want to go over sort of bit of a presentation that I can poke holes in and ask questions that might be in the audience's mind.
Yeah, and this is the first public outing for this presentation.
Okay, so I'm the guinea pig then, am I?
You certainly are, and
right.
and your listeners, viewers. Although I would say that I've been putting this together now for probably 5 or 6 months, maybe a touch longer, and it's based on my own experiences, but also regular and detailed discussions with other peers in the marketplace that are active in M&A as well. So I've tried to make this as true as I can, although there's only so much information that's publicly available around deals that have happened, and therefore you have to I guess weigh some of the topics here and against what you think is realistic. And I think that's really where the title of the presentation has come from, insofar as that there is no right or wrong to this. It's worth what someone's prepared to pay for it. So with that in mind, valuation and price, there's an important distinction to make, which we'll come on to in a moment. But yeah, so I'm just going to rattle through the first few slides, as these are my general for those who don't know me, and yeah, and as I say, stop me if you want to. But yeah, effectively, my background is a commercial track rather than a technical one. I'm a salesperson by trade, and my first role in IT was in '95, working for a value-added reseller, which I would argue is very similar to an MSP today, although different technology, and probably a more mature commercial route to market around recurring revenue, and more recently subscription-based IT delivery. 2002, co-founded Amacetia, the MSP that I was involved in, although we'd have called it an IT support business back then. 12
So what
year.
was,
Yep.
when you first started that, was it a sort of break fix IT support, bank of hours?
Um, yeah, all of the above really.
Yeah.
We had we had some fixed price clients. We had predominantly hours rather than true break fix,
Okay.
insofar as hourly rate
Yeah.
type stuff. There was always a requirement to try and get a commitment from the customer, and to to ultimately manage the revenue stream, and of course the balancing that with the resource that the business carries, and ultimately the happy space there is where you can get all of that singing together, and that's where you get your profit. So yeah, very much prepay, more of a move to fixed price as we could, and and I guess evolving. We were in the process of evolving into what today we'd call an MSP, at the point of exit.
Okay.
So that journey was 12 years, a bit of a roller coaster, and I'm gonna flick through the 12 years and summarise them into a number of categories. So at the beginning we were quite happy, and then unfortunately happiness turned to anger, and then anger led to sadness, and then ultimately we were left a little bit confused, and that cycle really continued throughout the 12 years, to be honest.
Okay.
So fast forward to 2014, and pretty happy again, if I'm honest. And but but very quickly you realise that uh, uh, there is life outside of being an MSP at the coalface. Discovered the MSP community a number of years after. Separately, I'll talk about my introduction to organisations like CompTIA, for example, which I had nothing to do with while I was in business and didn't really understand what what they were all about.
Yeah.
Discovered that afterwards, and in I guess re-engaging with the community, realised that I understood the pain and opportunities facing MSPs, and began working with the market, helping where I could,
Mm-hmm.
and productizing my offering, and that's ultimately led to, as you mentioned earlier, coaching, which I refer to as mentoring, people recruitment, and then solutions more recently around mergers and acquisitions, which happy to expand on later on this,
Okay.
if we have time.
Yeah.
But
So I get the
yeah.
question I've got you there about your business that you sold. Did you go? Did you actively go and attempt to sell that business, or were you headhunted? Did someone come up and give you an offer?
So we were actually active, both buying and selling. Our aspiration was, we felt we needed to grow differently to the way that we had grown, and historically we'd been a fairly direct sales business, to acquire customers, and even when you've got a good way of acquiring customers via direct sales activity, it still isn't necessarily going to happen overnight. So we were we were intrigued and we're trying to find people that we could buy, and ways in which we could fund those those acquisitions, and actually looking to buy was how we ended up selling. So we didn't set out to sell, but understanding the process on the other side, we realised it just made sense for us to sell rather than buy. You just you're on the fence either side of it. So
Okay.
you're going to be part of the market, whatever, whether you're buying or selling. And I think that actually leads me into the a summary of what I see the marketplace as. So first of all, we've got thousands of MSPs in the UK. I talk to vendors who are obviously actively selling to the MSP space, so they've got a good sense as to what the marketplace looks like. But subject to your definition of an MSP, the estimates are anywhere really between 6 and 12,000 MSPs in the UK alone.
And that's of any size, isn't it? That you're looking at there, from the one-man bands all the way up to 300.
Correct. And there are businesses, one-man bands starting 10 years ago could quite easily now be a 50-person company.
Yep. Okay.
And that cycle's going on continually. So yeah, there's birth and death within the market, regardless of M&A activity. It is fair to say, though, that the majority of that volume is going to be the tail. So you sort of, let's say, sub £1 million revenue businesses, and of course some of those are elevating themselves above that, and some of them are not doing that. They are they're at a point that they've got to organically, and they're unable to break through to that next ceiling of growth. Because of the age of the marketplace, we've now got a fair few number of owners of MSPs actually approaching, or in some cases past, retirement age, and effectively stuck within their business, in terms of what they need out of the business to fund their lifestyle, versus what they would potentially get if they were to exit the business.
Okay.
Growth plateau we've already talked about, but I think importantly, there's a lot of businesses out there where they effectively are very low profit businesses. Now, a low profit business can still provide a good living to an owner, but it doesn't necessarily mean they're developing a business that's got the an appropriate level of profitability to be considered in the same light as a mature business, within that traditional M&A space that I alluded to earlier.
Okay.
And then, because we're typically talking about smaller businesses that aren't necessarily involved in M&A activity as a regular topic, the whole concept of exit for them is just shrouded in mystery. There's probably a good deal of fear around it, and as I say, there, it's probably the biggest sale an owner will make, in terms of their business. So that's really what the background as to the marketplace as I see it.
Okay.
I don't know if that answers the question you asked a while ago.
That gives us a good overview, Daniel, and I think it's interesting that there's this low. It's almost like a living wage, or almost like a lifestyle business. And a lot of IT business owners, they go into running their IT companies, MSPs, because that's just what they've fallen into. They've never really thought about actually selling the business at any point in time. It
Hmm.
just so happens then you've got these, I guess they're maybe baby boomers or pre-baby boomers, but they're post-baby boomers, but they're, they're at that retirement age now, and they realize, oh, I need to keep up a certain lifestyle,
Hmm.
and I've got this business, and I'm stuck in the business. So with that, and with the this low profitability, it brings a lot of questions into my mind about how we can maybe, I can ask you these questions, but how we can maybe change that here. Some of the views and this mystery and fear
Hmm.
that you talk about. So the first thing is really the profitability of the business. I mean, that's kind of what you touched upon there.
Hmm.
On if I'm running an IT company, how is the value or the price? You say they're two different things.
Hmm.
How is it valued or priced, and what's the difference between the two?
Hmm. Yeah. Well, I'll come on to that in just a moment, actually,
Okay.
because the other thing that well very much drives that that value and price topic, and the education topic is who's actually involved in the marketplace. So just by putting this presentation together, hopefully there's a sharing of information which will educate and inform, at the very least remove some of the mystery, for those viewers and listeners, in terms of my opinion and my experiences. But it starts that process going, and it's important to understand who else is actually involved in the space. So we've got business brokers, which again your viewers and listeners will probably be familiar with, and I won't mention any names, but there's a marketplace there for uh, businesses that will effectively trade anything from a fish and chip shop to an IT support business to a manufacturer of widgets, and they're all very different businesses, but they're probably all at a certain price point where
Okay.
they're going to need to advertise for buyers, potentially, and that's where the seller has instructed someone to sell their business. You've got finance brokers, who are effectively providing uh, the the cash flow to enable an M&A activity. You've got investors that are uh, direct investors. Now they may or may not be going through business brokers, but ultimately, you probably refer to this as a private investor, so someone with money that wants to make a direct investment. And you've got the staff of the MSP, the customers of the MSP, and really what I'm trying to do in this presentation is literally focus on sellers, and buyers, and valuation as a qualification anchor, around lifting this shroud of secrecy. Um, so looking at sellers and buyers, just to provide a bit of background on where they're coming from. Sellers ultimately want the highest price. Um, uh, they very much see their business in terms of emotional investment, the blood, sweat and tears, the late nights.
Yeah.
Um, uh, they typically want to do right by their staff and their customers. I know that I did, and that was a consideration for me. Um, they should have a life plan post sale. Um, I'm not sure that I did, or if I had a
I
plan,
was
it
going to ask
was,
that question,
yeah,
but
probably a little bit different
okay.
to what it's ended up being. And a seller really should consider what if they were in the position of buying their business, what they would be prepared to pay for it.
Okay.
And of course, the seller wants to receive the best offer when the time is right for them to exit. Buyers, I don't think I'm going out on a limb here by saying that they, of course, want the lowest price.
You want the best deal, yeah.
The best deal at the best time for them. Buyers do see the value in the staff, the contracts, the customer relationships. They're the assets. That's what they're buying.
Okay. So that was one of the questions I had actually was from a value piece. If you maybe your contracts are 12 months or they're 36 months in length, is there actually value in having contracts that are 36 months in length as opposed to the 12 months?
Yes. Well, yes and no. I would generally say yes. The longer the contract, the better. There are pros and cons to it, because if your contract is 36 months, when is that period in relation to when you plan to exit the business? If you are if all of your contracts happen to renew at the same time, and your whole book is therefore a guaranteed 36 months of revenue, at the point of exit, then that's going to be, in theory, the strongest basis for evaluation and therefore price. Equally, if you're at the end of that cycle, having 36-month contracts probably isn't going to help you at that point of exit. So if you can work back to know exactly the point you are going to exit your business, then that's that's the relative value to having that length of contract.
Okay.
But equally, potentially it's harder to grow the business based on 36-month term agreements than it would be on, say, 24 or 12, or even the well publicized sort of 30-day rolling, low commitment, you stay a customer because of the service we offer. In theory, is that an easier customer to win, to build the business, to then have the business at an appropriate size to yield an appropriate value? So that there, yes is the answer to your question directly, but it's not the only thing in isolation that you should be thinking about, both in terms of planning how to grow your business and then how and when you're going to exit.
Okay.
Buyers will of course want profitable customers as well. So if you've got a 36-month contract, if you've won it on price and it's not creating the profit that it needs, then that's as much a hindrance as
that's another thing that's in the value. So I guess what's the main value factors then for a buyer? What are they looking for?
Well, they want to get their money back. And they want to make a profit. So
I guess what I'm trying to ask, Daniel, is if I'm running an IT business, what things I could do on a sort of day-to-day basis that would increase the value of my business? That's the question I've got.
Okay. It's pretty much everything that you would do regardless of whether you were planning to exit the business or not.
All right. Okay.
So making customers as sticky as possible, either via contractual method or level of service, servicing of the client, how close a relationship you maintain, how well you manage that customer to extract the ultimate value from them for you and for their purpose. Ultimately, if you're doing the right thing by the customer, you're probably doing the right thing by you as well. But thinking, I think the right term is altruistically. So underselling your service at a low price and low margin isn't actually doing the right thing for the customer, because it makes your business less sustainable and less likely to be there in 3 years' time to still be supporting them. So it's getting the right balance of all of the aspects of the quality of the staff you employ, the price that you sell your service at, as I say, the contractual commitment, versus other methods of stickiness, such as not having everything co-terms to the same renewal date. So maybe there's a backup or data business continuity solution that runs to a different contractual date to the core service, which would just make it harder for a customer to leave potentially. So that could be as important strategically for making that customer sticky as having a length of term being 36 months or 24 months, for example. But yeah, anything that you would do to make your business better and stronger and growing are all the things that are going to help with the exit value.
So should there be any routines, processes, systems that should be kind of maybe be doing on a daily basis, or habits that would make the sale easier?
Yeah, big topic to be honest. It's everything that all of the MSP supporting community would talk about. In specific M&A terms, something that probably most sellers wouldn't be doing until they get to a point of sale is actually providing themselves and therefore the buyers with the information and evidence that will be required during the due diligence phase. So this is effectively starting now. If you were exiting in 5 years' time, say, is actually almost journaling what's going on in your business, so that you can effectively present that to the buyer, almost like a service history if you were selling a car. But part of the due diligence process is you'll be asked questions about what happened with staff that have left. So maintaining a register of employees, alongside any other aspect or detail of your business, in what's referred to as a data room when you're in the due diligence process. So for example, the first, we're talking about staff, so have you got copies of your staff contracts, both current and former? So making sure that you are collating and having that those contracts, copies of those contracts in this data room, because you're going to need them in 5 years' time when someone comes along and wants to say, well, who's worked for your business, and because they want to understand the risk of those staff as much as the opportunity that they provide as well.
That makes a lot of sense.
So I'd almost consider it journaling, for want of a better description, but it's a bit more than that. It's creating this service record for your business.
Okay, that makes a lot of sense, and it's these basic things that can quite easily go missed when you're juggling running an IT business, that you can let some of the balls drop, and I guess it's just being aware of everything that needs to be kept.
Absolutely, and good record keeping is good business practice, regardless of whether you're planning to sell or not. So the final point on the buyers is, as with the sellers, they want to be finding targets that are ready to sell at the time when they're ready to buy. So just like if you were acquiring a customer by customer, and you'd have a sales process, a pipeline, a buyer should be thinking about creating that same type of environment, and conversely, the seller also needs to be building a pipeline of potential buyers.
Okay.
So all of this then comes down to what I call the qualification anchor of valuation. So again, assuming that seller and buyer have found themselves at the right time, there's going to be a negotiation around price, and there needs to be a common language. So if we go back to selling a car or buying a second-hand car, if you're the buyer, there is a there's a number of marketplaces you can go to validate the value. And you can say, well, if it was a 2016 car and it had this engine size and this amount of mileage, it's going to be this price range, whether you're a trade buyer or whether you're going to buy it from a retailer or buy it from a private seller. There is nothing like that for an MSP, the MSP market. So effectively, what I've tried to do in this presentation is provide a set of tools to help buyer and seller establish a valuation anchor point that can then be used within the negotiation for the price, which I'll come on to in just a moment.
Okay.
Again, there's lots of elements that will affect price, but ultimately the valuation is the figure that should be consistent. In the same way as when you're selling a car, you might have your I don't know if you still have, was it the glasses guide? Was that where you go and look and see what the price of a car should be? But the price of it, the price you pay, might be more or less. So if the seller really likes their car and they really don't want to sell it, and they're selling it under duress and they don't need to sell it now, they're going to stick to a higher price. If they really don't want the car anymore, they haven't got a garage anymore and they need to sell it, they're going to sell it for a lower price. And that's fundamentally the nub of what I'm talking about, difference between valuation and price.
Okay.
And then finally, on the topic of valuation and price, we're talking about money here, but that may not be the best basis or the primary basis for a decision on what makes a good deal or not. For example, if you are trying to find a buyer that will secure the future of your customers and staff, and the buyer is going to fund that acquisition by sacking staff to reduce cost, and therefore and might even trim the customer base because some of the customers aren't at the right level for them to operate a service that's different to what the way the seller's been managing the whole relationship, then that may be an unattractive purchaser for the seller. So therefore, it's getting that right balance between the price paid and the commitment to looking after customers, staff, etc. Ultimately that swings both ways for buyer and seller. So effectively, there's a number of valuation methods that are out there in regular use at the moment, and they all suit different situations. So what I've been working towards is effectively a triangulation method. And effectively, to do this, we take 4 valuation methods, and then we overlay them on top of each other to effectively get as true a valuation as we can.
Okay.
So the methods are, first of all, annual contracted services revenue, and we're looking at a 1 times multiple.
Okay.
Okay.
That's what I've heard before, is it's usually 1
Yep.
times. When I
Yep.
first was in this game, though, I thought, 3 to 5 times, that would be what I assumed. That's what I assumed. But 1 times is more of a realistic number.
Yep. And it's important to understand what number you're actually applying a multiple to here as well. So for example, in a mature established business, in that traditional M&A type environment, let's say a business that's maybe revenues of 5 to 10 million pounds, that size of business probably has a mature and evolved sales machine embedded within the business. So they are self-healing. They know, we know we're going to lose customers, we know we're going to suffer attrition, but the business is actually able to replace that because it's already got cost built into it to find and win new business and to grow. So that kind of business, there might be multiples of earnings of 5 times, for example, and you'll have maybe heard that and assumed that applies to a smaller business as much as a bigger business. And whether or not you're talking about contracted revenue or whether you're talking about turnover, that might include one-time revenue like hourly rate stuff, or hardware or software that's being resold. Again, some people would count that and some people wouldn't. So I'm being very specific here. It's annual contracted services revenue.
Okay.
And a multiple of 1. The next calculation that I see is a gross margin calculation. So most MSPs would probably admit to being around 50% as a gross margin for a service that's delivered, that they deliver from their staff or combination of their staff and contractors or master MSP, whatever their model is. So on the basis that they're making 50%, or if they were making 50% as a gross margin, a 2 times multiple would get you the same answer as the first method. But this does allow for a business that maybe is operating at a higher or lower than 50% gross margin, and will adjust the valuation accordingly. So if they're making better margin levels, then the multiple calculation would therefore be create a better answer for the seller.
All right.
The third method is probably closest to what traditional M&A of the variety I mentioned just a short while ago. Except here we're being specific about what we're applying the multiple to, and we're applying the multiple to something called EBITDA. Now, some of you viewers and listeners will immediately know what EBITDA is. Others won't even be able to spell it.
I'm in that second camp. I have heard of it before, and I'm writing it down now so that I remember it.
Yeah.
So
you can actually just if you Google it, you'll
what
get.
I'm doing right now.
Yeah, you'll get the answer. But in simple terms, EBITDA for most small MSPs is probably equivalent to their net profit.
Okay.
And officially it means earnings before interest. So any interest you might be paying on a loan, for example. Uh, Earnings before tax. So this is before corporation tax. Earnings before depreciation. So a charge to the profit and loss account for an asset that you've perhaps purchased and you're depreciating over 3 years, and an amortization, which is effectively very similar to depreciation, but it's where you don't have an asset with a realizable value, I think is the right way to describe it. But effectively it's you're spreading a cost as you would be with depreciating an asset over a number of years. As I say, in the majority of cases, this is what net profit is.
Okay.
However, it isn't quite that simple either, because I'm using the phrase here, adjusted. So there'll probably be a number of your viewers and listeners that will owner managers of MSPs that will pay themselves via dividends rather than a PAYE salary.
Yeah.
And they're doing that because it is it creates a more efficient tax level. But and it's absolutely what most what the majorities of listeners and viewers will do, assuming that they're making a profit, so that they can then vote dividend, and they'll probably have a very low basic salary, again optimizing implications for national insurance as well. Now that's absolutely fine whilst you're not planning to exit the business. You're effectively elevating the profit of the business because you haven't allowed for the remuneration of the owner, manager, director, etc. So EBITDA in this case has to be adjusted for an appropriate level.
Okay.
And that's where you end up with a business that might say, well, I'm making 10% net profit, say, and then I'm being paid a dividend. Well, 10% is probably where most MSPs should be after a remuneration has been paid for the owner manager. So therefore, when we add back, we end up with effectively a very low or no margin business, and that walks straight into what you mentioned earlier, a lifestyle business where it provides a very good earning for the owner manager, but needs to be viewed in the right way when it comes to exit.
Okay.
And typically the multiple that's used there is 5 times. So if you've got a business that is making, say, 100 grand as a adjusted EBITDA, the very simple calculation there would be that it's going to be worth 500,000.
Okay. And there's a fourth one, is there?
And there is a fourth one. The fourth one is I call it business plan. This is effectively what the buyer is going to do on day one post completing the purchase. So they're going to probably integrate it into their existing business. There'll be ongoing sales activity. There'll be ongoing management of the clients. There'll be a different cost structure, and they need to work out what margin they're going to see from the business during the first 2 years, and that ultimately is how they're going to set the value that they're prepared to pay for the business, so that in year 3 and beyond they are making a profit.
Yeah. Okay.
Okay. Now I'm saying 2 years. Again, you could stretch that to 3 years or 4 years. The more you do that, though, the longer it's going to take for the business to pay back the buyer, and therefore the less attractive a proposition it's going to be.
Okay.
So they're the 4 methods.
You mentioned this triangulate. Is this like an
Yes,
average or?
exactly right.
Okay.
So, and different businesses will have different attributes, and therefore will perform better, in some or others of these methods. All of them, though, it's appropriate to add, will then be affected by the book value of the business. So this would be ultimately what the balance sheet is worth. So in simple terms here, I'm saying plus or minus net assets. So if the balance sheet says the business is worth 100 grand, for example, and we've got our EBITDA multiple and it's a true 100 grand and we're happy with that, and they had 100 grand net assets, the actual value of the consideration would be 600,000, i.e. 500,000 for the EBITDA plus the net assets.
Okay.
And I've then got an example of how you can apply those methods. So in this imaginary situation, we've got an MSP with a revenue of £1 million. It is generating a 10% after the shareholder market rate salary has been added back. That £1 million has 400,000 of annual services contract revenue, which is at a gross margin of 50%. You can probably see where I'm going here already. Mm-hmm. And it has 0 net assets, so the balance sheet is 0.
Okay.
So valuation examples. Number 1, which was our 1 times contracted revenue, is 400 grand. Number 2 was our 2 times gross margin, which gives us the same answer because it's 50%. Option 3, which was the EBITDA times 5 multiple adjusted for appropriate remuneration for the shareholder owner manager, which in this case we'd already adjusted it, so it was already making 100 grand, so we've got 500 grand as the answer there. And then finally, based purely on experience of business plan valuations, there's normally more margin that gets unlocked by looking at the business plan model.
Okay.
And by which I'm talking about margin from products and subscription sales, margin from project or ad hoc work, hourly rate stuff, for example. Mm-hmm. All of that can get released into the business plan and therefore can form part of the valuation. But I've had a guess here and I've put 600 grand. I don't know what it is because it's imaginary anyway, but it would be more. Okay. And then I've taken an average, and my average is 475. So in summary, what we've done there is try to take a number of methods, hopefully explain what those methods mean, mm-hmm. and then apply an example. As I say, though, this just gets us to valuation at this point. Price is another thing.
This is when the negotiations start.
Exactly right. Exactly. Okay. Right. And you could argue that you're negotiating from the very from hello, basically. But because if you agree a higher valuation, then that effectively makes your price barrier higher, but it probably just reduces the amount of flex that the price affecting elements can have on the valuation. So in some ways you rob Peter to pay Paul.
Okay.
Some of the things that are going to affect valuation, though, that are worth considering, is going back to one of your earlier points: length and strength of contracted revenue. So really, we're only taking 12 months in our 1x multiple. So does it really matter if you've got a 36-month contract?
Mm-hmm.
Well, yeah, maybe it does if you are going for a business plan type model, and therefore you want to know that you've got that revenue contracted beyond the first 12 months of that arrangement. Forecasted non-seller dependent growth and evidence of the trend. So basically what I'm saying there is, if I'm the only person that ever gets new business and there's no other mechanism around it that will continue should I exit,
Yeah.
We can count it into the price mechanism. So again, that leads to the point I alluded to earlier: more mature business with a sales and marketing function that operates independently within the business from the owner. That's gonna be more reliable and last longer than the fact that I know someone down the golf club that refers me business, and I've got a nice vein of opportunity that I've taken advantage of, but
Mm-hmm.
won't continue after I've gone. Staff liability and link for service. So this potentially is something that will weigh down a valuation or a price. If everyone's worked for the business forever, that's great for longevity and strength of relationships, therefore, with the customers, but also represents an elevated cost liability should someone or should someone want to remove someone from the business, or have some level of redundancy, because the longer the person's been with a business, the higher the liabilities of that cost, which plays into my other point earlier I made, which was, when you're selling, do you want to sell to someone that plans to make redundancies in order to fuel the higher sale price?
Okay.
The money's got to come from somewhere.
Yeah.
Payment profile for the deal. That could be, when do you see the money? Is it all up front, or is it all on an earn-out? Again, an earn-out is something that your viewers and listeners have probably heard of, and that basically is where money is paid over a longer period of time, rather than at the point of completion.
Okay. So it's not just one lump sum.
Not just one lump sum, and that payment profile will also be affected by whether those payments are performance or contracted. So performance, we're saying if the business does well and it and effectively it grows, or contracts that you expected to happen, then the payment that was modelled on that basis is going to be made, and that's going to be great. But equally, if the buyer elevates it and they make more money, then the seller makes more money. Equally, though, if the buyer doesn't do a very good job at executing, or when the seller leaves, it all falls apart because it was all based on the seller being
Yep.
intrinsic to the business, and they do less, then that payment and therefore that price will be lower. So performance-based or contracted-based payments.
Okay.
Contracted-based are where you say it's going to be this price regardless of what actually happens, and that will affect price. Costs. So the buyer and the seller will have costs, subject to the structure of the deal. So most reasonable size MSPs will want to sell the shares in what's called a share purchase agreement, and the reason for that is tax efficiency, and because you're buying the shares, you're buying the risk as well as the opportunity of owning those shares bring.
Mm-hmm.
So there quite rightly has to be an appropriate amount of legal and accounting advice, guidance, and agreement. If you are in a lower value deal and effectively you're selling goodwill and you're not transferring shares, that has a much lighter legal and accounting cost, but doesn't have the same tax benefits for the seller. So cost of the deal relative to the value is going to affect price as well.
Okay. And I'm guessing that one of these might be the seller and what they're going to be doing once the business has been sold. That maybe comes into it somewhere.
It's as if you've seen the slides ahead of
Yeah.
the presentation, or you're just very attuned to the topic. But yeah, absolutely. Seller's role post sale, really intrinsic to the price. And again, this goes both ways. Some buyers will see the seller being involved in the business
Mm-hmm.
post-sale as being a great advantage, and will help settle any nervousness across customers and staff, and really solidify that transition period.
When you sold your MSP, Daniel, did you
Yeah.
just automatically vacate, or were you still involved in the business?
Yeah, so I guess I did an unconventional. I followed an unconventional journey insofar as, I was exiting at exit,
Okay.
and as is common in that situation, there's a handover or consulting period where you remain involved in the business, but you're not really active. You are, again, making sure that everything beds in appropriately. You support the buyer in integrating the staff and the customers, and making sure there's a full and proper handover.
Okay.
And at that point, I was exiting the business, had no role in the company moving forwards. But in my situation, having had a period away from the business, 8, 9, 10 months later, I joined / rejoined the acquirer, and then took on a role and directorship shareholding in the buyer's business, but that was not planned at the point of sale.
Okay.
So effectively, that was a separate agreement. So wouldn't have affected the price and valuation in my circumstance.
Okay.
But sorry, just to finish off the alternate situation is, sometimes the buyer won't want the seller involved moving forwards, because the seller may well not be on board with the vision of the new business, in terms of the direction they
Okay.
they might cause more damage than they help with. So and so again, that's part of the buyer and seller negotiation around, well, what does each want to do, and is there an opportunity to create a role for the seller, because the seller's role will change. It won't be the same as it was when they
Mm-hmm.
were in control of the business.
Okay.
Um, this is probably a fairly obvious one, but sellers' desire to sell will affect the price. As I was saying about earlier, you're selling a car, you haven't got a garage to keep it in anymore.
Yeah,
Got
you're
it.
desperate.
You've got it. Yeah. And so and also why they're selling, what they need the money for. That will affect price. So might the price be higher because some of the valuation or some of the consideration is deferred. In effect, the seller is lending some money to the buyer to buy the seller's business.
Mm-hmm.
In simple terms.
Yep.
And then of course the opposite to that is the buyer's incentive to buy, will the buyer pay a premium because they don't just want to grow their business, they have to grow their business because they've borrowed money to grow their business, and therefore they've committed to achieve certain targets and milestones.
Okay.
So uh, so uh, so the buyer really wants to buy the car, they'll pay a higher price. So both seller and buyer's desire or incentive will affect the price, and it sounds obvious to say, but you may not think that this is, these are all very real
Mm-hmm.
tensions around the transaction.
Okay.
But in truth, the list goes on.
It's
And
endless. Yeah,
yeah,
it's a big list. I mean, one of the ones that
yeah,
I don't think has been brought up here, and this is actually what I've heard before with a local MSP where I'm based,
mhm,
is that they were acquired because of one customer that was on their books. It was perceived that this one customer, probably in oil and gas, because I'm in the northeast of Scotland,
mhm,
because they were managing the IT services for that customer, it was like just buy the whole business to get
yeah,
in with that customer.
yeah. Yeah, and that I wouldn't doubt it. Yeah, that's another another very valid reason.
Mm-hmm.
And in smaller markets, or where you've got bigger players, and again, this is probably more larger business, corporate enterprise, M&A type activity, but sometimes they're buying competitors to remove the competitor,
Yep.
um, as much as to gain what the competitor has in terms of assets. Um, I don't think that would apply in the MSP world, especially the tail end of the MSP world, which is what I'm really talking about here. I'm talking about your
Yep.
your £1 million-ish and below type businesses, and yeah, and ultimately, uh, you know, you swallow up one competitor, but there's still another. If you're based in central London, I think there's maybe 500-600 MSPs operating inside the M25.
Mm-hmm.
That's just the ones that are based inside the M25. Then you've got all the ones outside it that reach in via train links and so forth. And so
Yeah.
actually, if you're operating in central London, maybe you've got 2,000 or 3,000 competitors. So buying one to remove it isn't going to be the
It's not
reason.
going to
You'll
work.
but yeah you'll buy it for the positives of the acquisition, rather than the positive negative, or whatever whatever that would be. So
Okay, so I think, I mean, I have a list of questions here, Daniel, and I think you kind of answered all of them within that
Okay.
for me. Um, one of the ones that I had here that maybe it's kind of maybe a bit generalist, but is there one piece of advice that you would give to someone that's looking to sell their business, like maybe something that you've seen go wrong in the past or from your own experiences, from a sort of one major bit of advice that would be helpful?
Um, uh, yeah, I think probably if you distilled it all down um, into what's absolutely top of the pile,
Mm-hmm.
I think it goes back to the first or the last of the first points that I made about um, the fact that this is all shrouded in mystery, not not fully understood. Lots of fear and emotion all wrapped around this, um, uh, and therefore I think the advice has to be for anyone that is considering an exit is to not not view the topic as a taboo and to only look at it when they're ready to look at it, but to be thinking about it now, even if they think it's 10 years, 20 years, or never. If they think they're going to pass the business on to a family member,
Yeah.
or in the case of uh, at least one MSP I know of, actually become I don't think it is a cooperative, but effectively the staff own the business.
Okay.
Um, uh,
I've heard of that
and
before, like a management
yeah,
buyout. So the management team take on a nice loan to buy the owner out of the business.
absolutely right. Yeah. So management buyouts, management buy-ins. I think it was almost a John Lewis type, and I don't quite know what the legal structure is for that, but effectively an employee-owned business. So
Okay.
regardless of what you think the outcome might be, um, it's important to understand um, to understand the process, even if you don't, even if you're not planning to engage in it straight away. um, what I've learned over the past 5 years would have been invaluable to me 5.5 years ago,
Okay.
in terms of preparing me, um, well, giving me the knowledge that I know now that I
Yeah.
didn't know then, but also then, probably I say going back 5.5 years, and 6 months is a typical deal length from having some initial conversations to completion. By the way, by the time you've gone through that due diligence and legal and accounting process, but actually going back uh, to, to 12 years before that. And I think again, if I knew then what I knew now, I'd have done things differently, and I think I would have achieved a different outcome. So yeah, it's being open to and inquisitive as to the M&A process, um, even if you've got no immediate intent to sell
Yeah. That
or
makes a
buy
lot.
or
That
buy.
makes that
Yeah.
makes a lot of sense to me. There's things that I'm doing just now with IT Rockstars, and I'm like, oh, this would be really cool if I implemented that. So one of the things we've got at IT Rockstars is a lot of membership sites. They talk about having a community and having a forum, and I'm
Hmm.
thinking to myself, I'm scratching my head like, maybe I could do my forum in Microsoft Teams. Maybe I could just have a team for all our members.
Hmm.
And then I'm thinking, actually, look at this from the perspective of someone that's going to sell the business in 10 years from now. What's
Hmm.
going to be more valuable, having that, that sort of digital asset in a forum or just a Microsoft team or whatever. So
Hmm.
that's my example anyway, that
Yeah.
always trying to be thinking about what's going to provide more value for is having that longer term plan more than anything else for the business. Um,
Exactly.
the way I look at it, everyone's got to retire one day. So while you might not necessarily think you're ever going to sell your business,
Hmm.
well, you're going to have to retire at some time. You're physically just not going to be capable. So
Hmm.
what happens to your business then?
Yeah.
Um, And I guess that's where you come in then, Daniel, because you've had this past experience of selling your MSP. You've been working with MSPs for the last 5 years. So you've got this invaluable sort of information. How do people get in touch with you, Daniel?
The website is of course a great resource. And then just as I flick through the last set of slides, but yeah, there you go. That's how best to get in touch with me, via email, or I'm on LinkedIn. The website is there as well. Yeah, just have a look, and I'm always up for a chat and a coffee. Yeah, always happy to talk to our fellow MSPers.
Awesome. Okay, Daniel, I'm sure you'll be on the show again. So everyone, thanks for watching today. We've got a real treat on the show for you next week. So this is season 2 we're doing of IT Rockstars. It was just over a year ago we did season 1. Next week we're actually going to be interviewing the complete opposite. So Daniel, he's sold his MSP. We're going to be interviewing a guy that's only 23 years of age. He started up his own MSP. He's been doing it for the last 8 months. We're going to have him on the show. So stick around for that. Hit the like button, hit the subscribe button, and remember to check out itrockstars.net. Thanks for being on the show, Daniel. I'll catch you again later next time. Bye, folks.
All the best. Take care. Cheers.